Welcome everyone, and thanks for joining this afternoon's seminar. My name is Andrew Godwin, and I'm an Associate Director of the Melbourne Centre for Commercial Law, the research centre that's hosting today's seminar. I'm also Director of the Melbourne Law Masters, in which Professor Arner has taught now for many years, almost 2 decades. So let me start by acknowledging the traditional custodians of the land on which we meet here in Melbourne, the Wurundjeri people of the Kulin Nation, and pay my respects to their elders, past and present. I'd also like to extend a warm welcome to any Aboriginal or Torres Strait Islander people who might be joining us today. So the focus of today's seminar, the geopolitics of cross-border money and payments, is topical, particularly given developments in recent times and geopolitical challenges and tensions that exist at the moment. Professor Douglas Arner is exceptionally well qualified to talk to us about these issues. Douglas is the Kerry Holdings Professor in Law at the University of Hong Kong, and also more recently, Douglas was appointed the Sir Roy Good Chair at Queen Mary University of London. As I mentioned, Douglas has been with us now for many years, teaching in the Master's program, a subject called International Financial Systems, and the second last day of your teaching. So we're very grateful that you could find time to be with us tonight. Douglas is a global authority on financial systems and financial matters generally, and many of you will be familiar with Douglas by virtue of the huge contribution he's made in areas such as fintech and regtech. In a recent paper, one to which I think you'll refer today, Monetary Hegemony, Technological Evolution and the International Monetary System, Douglas and his fellow authors, Ross Buckley, Dirk Zetscher and Anton Didenko, examined the technological revolution in monetary and payment systems and consider a number of important questions. And I'm paraphrasing a few of these questions, but I thought it'd be good to get people to think about some of the questions that may be relevant to today's topic. What impact will cryptocurrencies and central bank digital currencies have on existing cross-border payment systems? What impact will ongoing conflicts and sanctions have on the global monetary system? In particular, and I think this is especially relevant in the context of the current trade dispute, what is the impact of all of this on the status of the US dollar as the global reserve currency and the so-called exorbitant privilege that the US enjoys as a result of the status of the US dollar? And finally, just another question to throw into the mix. Will we see a move towards a system in which a few central bank digital currencies will dominate? Or either in addition or alternatively, will we see a breakdown of the current rules-based order as it applies to the world's monetary and payment systems? So we all look forward to hearing you, Douglas, on these and related issues. And so if you could join me, please, in welcoming Professor Douglas Arner.
Thanks very much, Andrew, and thanks to everyone for joining both in person and online. It's always good to be back, and this is someplace that I really enjoy speaking every year. As Andrew mentioned, what I'm going to be speaking about today is this idea of geopolitics of cross-border money and payments. So what I'm going to be talking about today, the context of this is one of my friends, Pierre Verdier at the University of Virginia, has put together a project organized via the American Society of International Law. And essentially, he's looking at the role of geopolitics in the context of finance. And not surprisingly, I was tasked with the specific topic of looking at the geopolitics of finance and technology. And so that's kind of the origin of this particular paper, that project. And so what essentially I want to do is draw on first some work, as you mentioned, with Ross Buckley and Dirk Zetche in particular, our recent book on finance technology and regulation. And one of the key themes of that book is the idea that finance, technology, economic structures, legal arrangements are co-developmental over time. And that's something that in this sort of graphic, we flag as an illustration of the last 150 years or so of a process of digital transformation in the context of finance. And coming out of this, and this was actually a topic I think I spoke about last year when I was here, I identified 4 areas where I think that co-development process is set to have a major impact on the way that financial markets work. And those 4 are the areas of cross-border payments that I'm going to be focusing on today. Second, data, which I'm not really going to be speaking about today. Third, digital assets and its transformation into a regulated industry, which is directly related to the topic I'm going to be speaking about today. And if we look at this question of money and payments, in a recent piece, as Andrew mentioned, Ross, Dirk, and Anton and I look at this question of the evolution of the international monetary system. And the traditional approach to the international monetary system largely takes an approach based on functional uses of money. The focus around its role as medium of exchange, unit of account, store of value. And typically, when one is looking at questions of the dominant monetary instrument at any given point in time, the focus tends to be on a sort of geopolitical, geoeconomic argument that generally suggests that there's a relationship between whatever the dominant monetary instrument of the time is and whatever the dominant economy or political actor or actors of the time is. And we question this to a certain extent, not least because if we look at this region, the dominant monetary instrument for the 3 centuries prior to the 20th century was the Spanish silver dollar. And there's no argument that Spain was the dominant economy in East Asia over those 3 centuries. The reason why the Spanish silver dollar was the dominant monetary instrument largely had to do with convenience and path dependence. At a certain point in time, it had emerged as the most easily usable monetary instrument, and that in fact, it was supported via a variety of mechanisms that enhance this. And this is where we really focus on the interreaction of not only from the standpoint of those functions, but also payment systems. The role of systems which actually make it easier to use a given monetary instrument, particularly from the standpoint of cross-border transactions. And I think the real contribution of this paper is we add in the evolution of technology and also legal arrangements to this traditional economic and geopolitical analysis to suggest that, in fact, in many ways, it's that combination of path dependence enabled by technological and legal arrangements that often has a determinative impact on choice of monetary instrument at any given point in time. And this is something that today I'm not going to sort of review that evolutionary process, but the suggestion of the paper that I'm talking about today is that if we want to think about the monetary and payment system today, we need to look at the fact that two things are happening. One, the technological horizon within which that monetary system, today dominated by the US dollar, operates, that the technological horizons of that system have changed. And that in fact, over the past 50 years, we have seen a complete technological transformation of the environment of cross-border money and payment. And one can look at this from the standpoint of both centralized systems. So one can think about the evolution of real-time gross settlement systems from the standpoint of wholesale payment systems, really from the late 1970s up to the present. But one can also think about a series of decentralized changes. One can think about the advent of blockchain, of Bitcoin, of cryptocurrencies from around 2008, 2009. But one can also see a variety of areas where these are coming together. One particular example is in the context of stablecoins. Another is in the context of central bank digital currencies, which, despite the advent, or if you will, the incentive of various decentralized structures, essentially every central bank digital currency system is actually a centralized structure rather than a decentralized system. And if we take that technological context, one of the biggest discussions in money and payment in particular over the past couple of decades has been around legal and regulatory issues coming as a result of the changing systems. This idea that this move into new technological approaches to money and payment is having a fundamental challenge to the traditional legal and regulatory approaches. More recently, and this is something that is, I think, received an increasing amount of attention, particularly since the start of the Russia-Ukraine war, which is around geopolitical issues, perhaps impacting the use of the US dollar. And I think the key point here is actually to keep in mind that at least since the establishment of the Bretton Woods system with its central role for the US dollar, and more particularly from the breakdown of the system of fixed exchange rates between the US dollar and gold in the early 1970s, that the system with the dollar at the center has been criticized for that entire period. This idea of criticizing the central role of the US dollar, this idea of monetary hegemony, is by no means new. And if I think about my entire career and yours as well, this has been a criticism, a debate that has been going on. It's not new. But there is an argument that the technological environment has changed and that this may impact from the standpoint of some of those convenience factors. And second, that perhaps we are seeing some of those geopolitical and geoeconomic changes that may impact from the standpoint of the way the system operates going forward. And the paper then breaks that down into analysis at the retail level of the sorts of situational changes we're seeing, and also at the wholesale level. From the standpoint of retail, I think there has been, from the standpoint of users, and it's certainly something that we see in parts of this region, I would suggest particularly in the context of India, but also the Association of Southeast Asian Nations. We also see it more recently in the context of Brazil. This is a series of countries where the advent of domestic fast payment systems has really quite rapidly transformed the expectation of users in those jurisdictions about how they will be able to make payments. And certainly if we think about India, Brazil, much of ASEAN, the expectation in these economies is that one will be able to make essentially instantaneous payments on the basis of a mobile phone number or an email address, and that there's no reason why this shouldn't happen both domestically as well as on a cross-border basis. And I think my suggestion is that from the standpoint of cross-border retail payments, this is likely to have, and already is having, a major impact on expectations. We've seen a number of projects, particularly a project called Project Nexus, which has been led by the Bank for International Settlements, the International Organization of Central Banks, in coordination with the developed central banks of ASEAN. And essentially that system is designed to build a structure to allow domestic fast payments to be used on a cross-border basis. In other words, that one would be able to make a payment from Thailand into Malaysia on the basis of the respective fast payment system using just a mobile phone number or an email address. And from a technological standpoint, all of the countries involved, the systems have been developed in the past decade. The end result is technologically, the systems are quite similar. So linking the technology is not difficult. The difficulties are really, one, around legal and regulatory issues. In other words, how is the system going to work? That's one. Two, how are you going to deal with disputes, particularly relating to fraud and crime? And the third is, how do you actually deal with things like AML requirements? Now, from the standpoint of AML requirements, Southeast Asia has been working on essentially building harmonized regulatory systems since the Asian financial crisis in 1997. So there's a high level of comfort between the more developed members and their AML regulatory system. So that has been workable. The technology has been workable. The issues at the moment are trying to sort out around problems of fraud and crime in particular. But there is a second level issue, which we'll come back to shortly, which is around foreign exchange. And if we think of foreign exchange markets globally, one of the advantages of the US dollar is that from the standpoint of cross-currency liquidity, most currencies have greater liquidity against the dollar than against any other currency. And so historically, there has often been a situation where if you were making a transaction, a transfer between Thailand and Malaysia, you would actually typically go baht dollar, dollar ringgit. You wouldn't actually go baht ringgit because there was greater liquidity in baht dollar and dollar ringgit than direct on the cross-currency pair. And this is one of those areas where there is a second level issue that remains, and I'll come back to that. The second area where we're seeing quite rapid development is in the context of regulated stablecoins. And this is something where if we think about the last 15, 16 years, the evolution of cryptocurrencies, digital assets, we have seen a cycle of crises, basically ups and downs. Each of those crises has been marked by a set of regulatory responses. And the end result is that today we can largely look at digital assets in an increasing range of jurisdictions, including likely the United States by the end of this year, as a regulated portion of financial services, with regulation covering AML, licensing of intermediaries, a variety of frameworks on segregation, custody, and enforcement, and regulation of stablecoins. Now, the regulation of stablecoins process actually dates back to an announcement by Facebook in 2019 of its own intention to develop its own essentially global stablecoin, which drew a very negative reaction from regulators as well as just about everyone else around the world. One result of that process was an increased acceleration of working on central bank digital currencies. A second aspect has been the development of regulatory approaches for stablecoins as a regulated form of payment instrument. And so what we are seeing, and there's a real, I think, question in the market right now. There's certainly one aspect in the US, which is viewing regulated stablecoins, in fact, as a means to reinforce dollar convenience. In other words, if everyone can get access to the US dollar through regulated stablecoins, this in fact makes it easier in many countries to actually use the US dollar for transactions. And arguably, from the standpoint of demand for US dollar assets, such as high quality liquid assets like government securities, if one sees very high demand for US dollar stablecoins, which are backed by high quality liquid assets like US government securities, that in fact provides a new source of demand for US government securities, as well as making it easier to actually use the currency in the context of transactions. So there's an open question about whether or not we will see US dollar regulated stablecoins, particularly as they're rolled out by regulated financial institutions globally, what sort of impact this will have. At the same time, there is the view that similarly other major currencies, particularly the euro, but also potentially the Swiss franc and even the CNY, that if we were to see similar sorts of regulated stablecoins, that this could in fact be an avenue to increase the use of those currencies. But an open question. What are we seeing in the cryptocurrency standpoint? At the moment, two things that I think are interesting. The first is, if one is thinking about currency substitution, it's really only occurred in jurisdictions where there are problems with the existing monetary or financial system. We haven't seen them as a real alternative to major or even well-functioning currencies. But with that said, there is a very interesting set of data, and the UK FCA, as part of its sort of new growth mandate, was highlighting some of this data. And there's an increasing amount of data that suggests for a large portion of countries in the world, people under 35 years of age have been more likely to have used digital assets than traditional financial services. And so what this means, and this is the UK included, if we look at a significant portion of the world, one has an infrastructure which has been built, which people are using, but there is a demand for better quality instruments. And so this is one area where we're seeing either the argument that central bank digital currencies or perhaps regulated stablecoins may step in. What are we seeing with retail central bank digital currencies? There was a lot of excitement as we saw really dramatic increases from 2019 after the announcement of the Facebook project and the announcement by the People's Bank of China, the Chinese central bank, of its plan to roll out a nationwide pilot for what was originally called DCEP, the Digital Currency Electronic Payment System, now is generally called in short, the ECNY. a lot of enthusiasm about retail central bank digital currency projects. And we've seen lots of central banks entering into these projects. But we haven't seen the scale of take up with any of these projects that was perhaps expected. And that, I think, is raising an increasing level of caution amongst central banks around the world. In other words, central banks are by nature fairly risk averse. And to the extent that they're launching something, they don't want to be in a position where they announce something with a lot of fanfare and nobody uses it. That doesn't really work very well. And so we're seeing a scaling back of many of the retail central bank digital currency projects. They're still going on, but generally we're seeing them focused more from the standpoint of arguing that this is a backup, that this is a means for appreciating innovation, or for perhaps reducing cash. I would say probably the big exception here is the EU, where the EU is focused very heavily at the moment on development of its own retail central bank digital currency, arguably because it's looking to create a set of infrastructure that is, if you will, very EU specific, in the same way that perhaps UPI in India or PIX in Brazil have been in the context of those economies. So if we look at central bank digital currencies, I think generally speaking, we're seeing less enthusiasm from the standpoint of retail projects in most jurisdictions. And it may be because in quite a lot of places that the various fast payment systems projects have developed so well. And if one has very high levels of take up through some sort of fast payment system like a UPI or PIX, this reduces, if you will, the need for or the potential attractiveness of a retail CBDC. However, where we are seeing activity is increasingly on the wholesale side. In other words, that as we see the evolution, particularly of the digital assets industry, we're seeing today an increasing range of traditional transaction structures, debt capital market structures, as well as a variety of different forms of tokenized securities, which is resulting in a demand from wholesale market participants for digital monetary instruments that can be embedded into transaction structures. And this is driving a real interest and demand for wholesale central bank digital currencies. And this is something that we're seeing a number of jurisdictions experimenting with around the world. Interestingly, the US, while of course it has gone completely away from a retail central bank digital currency, the reality is that when we're talking about wholesale central bank digital currencies, increasingly this is seen as interchangeable with an RTGS system. In other words, if a central bank is creating domestic currency liquidity through its RTGS system, this is a liability of the central bank. It's identical in a non-tokenized form to what one would think of as wholesale CBDC. Now, if one simply tokenizes in some form central bank money via an RTGS system, that is effectively a sort of tokenized wholesale CBDC, which can then be used in transactions. We're seeing a variety of projects looking at different ways that this could take place. But I think one of the interesting things from the context of this particular paper is that problem that I flagged with currency liquidity. In other words, the fact that it is for most currencies easier to go currency, dollar, dollar, second currency, as opposed to direct. And what I'm seeing around the world is there is very much an interest in almost every country that I run into in increasing the use of their own currency internationally. There's not necessarily a desire, for instance, to replace the US dollar with some other domestic currency. Rather, most of the motivation is about, is there a way to use one's own currency increasingly? Now, one of the challenges to this is really that sort of currency liquidity. And this is one of those areas where we're seeing some projects, and the one that's received the most attention is another BIS project called Project Imbridge that originally involved the Hong Kong Monetary Authority, the Central Bank of Thailand, the People's Bank of China, and the Central Bank of the UAE. Like Nexus has now left the BIS, and its participants are in the process of trying to create it as a standalone entity. Similarly, Imbridge has now started that process with its participants trying to figure out how to build it into a standalone entity. And the question is that a platform which can make it easier to transact essentially blocks of foreign exchange at a wholesale level directly, and therefore reduce some of those dollar liquidity advantages in foreign exchange markets? This, I think, is an open question. And this is going to be one of those points to particularly watch over the next few years. Looking forward, I think the question is going to be this dynamic interaction between technological changes that make it perhaps easier to use a variety of US dollar alternatives on a cross-jurisdictional basis versus some of the geopolitical issues which could drive motivations of users in a different direction versus what easily could happen in the context of the stablecoin environment, which could reinforce the ease of using the dollar, or it could make it easier to use others. But in many ways, if we're thinking about major international competitors, from the standpoint of the US dollar, the key advantages that it maintains, in addition to those sorts of liquidity and ease of use aspects, are first from the standpoint of the unit of account. Unit of account is one of those things that I think would take a long time to get the same sort of general acceptance of the US dollar. Everywhere I go, it's difficult to find people who don't communicate in dollar-based figures. And that means that from the standpoint of a unit of account, a conceptual framework, it's very difficult to build alternatives. And I don't really see things like cryptocurrencies or stablecoins. Yes, I do know a few people who speak in Bitcoin, but the majority of people translate Bitcoin to fiat currencies, most frequently the dollar, and use that as actually the unit of account rather than speaking of BTC. So I think the unit of account framework is one that may linger for a very long period of time. And in some ways, this was actually one of the advantages, for instance, of the Spanish silver dollar, which of course remains embedded in the names of a surprising number of currencies around the world, reflecting this fact that there was this common framework of account even after the instrument had stopped being used. The other area is really from the standpoint of the store of value problem. If we look at the medium of exchange, this is one of those areas where payment systems, trade flows are likely to make it easier to increase use of domestic currencies and a variety of alternatives. But where we are seeing very few alternatives is from the standpoint of a sort of equivalent safe asset market, particularly to the US Treasury market. And this is something that so far, for a variety of reasons, we haven't seen either of the next two most widely used currencies, the euro or the CNY. Neither group has been willing to undertake the various sorts of developmental steps to build a highly liquid, safe asset market that could actually serve as an alternative to that existing US dollar market. So my takeaway from the analysis in this paper is that I think we're seeing a combination of technological changes, geopolitical frameworks, and legal arrangements that are making it easier to use alternatives to the US dollar. We're seeing a variety of geopolitical forces which are providing incentives for an increasing range of users to adopt or use alternatives. But from the standpoint of certain aspects, particularly the unit of account, but more fundamentally, the availability of a large, liquid, safe asset market, that at this point in time, there aren't real alternatives. So that's kind of the thesis, the argument, the analysis, and very happy to discuss any sorts of related issues.
Douglas, thanks very much for sharing your thoughts. And thanks to all of you for joining today's seminar. So if you'd put your hands together to thank Douglas in the customary way. Thank you.